Welcome, everyone. My name is Gretchen Schmitz, and I'm with Transition Advisors. Our webinar today is How to Admit New Partners. Before we begin, we need to cover a few very important items. First, please close all the other programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors for NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive your 1.2 CPE, you must complete two requirements. First, you must participate in all 4 polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation. Partial credit will be given for those answering 3 of the 4 polls. Next, you must complete an online evaluation that will appear on your screen immediately after the end of the webinar. Please do not close your browser before completing this survey. Once these requirements are met, the certificate will be emailed to you within 10 working days. In order to fully participate in the webinar, please familiarize yourself with your GoToWebinar control panel on the right-hand side of your screen. The orange arrow on the top of the control panel is to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box towards the bottom of your control panel. Just type your question in the box and click Send. Terry will answer all your questions during our presentation if time allows, and we welcome your participation. Terry will also be sharing his webcam during today's presentation. You are welcome to resize, minimize, or even close this if you wish. On this slide, you will see a list of upcoming CPE webinars. Our president, Joel Sinkin, will be presenting several more webinars with the CPA leadership in November and into 2020. You can register for these upcoming webinars by following the link on our website, transitionadvisors.com. As a reminder, you received a link in the reminder email to download a copy of today's presentation. I will be sharing the same link via the chat function of GoToWebinar in just a moment. Now, I would like to introduce our presenter for today's session, Terry Putney, CEO of Transition Advisors. Thank you and enjoy the webinar.
Thank you, Gretchen. I wish I could, sit with each of you and kind of go over your individual needs or why you're in this webinar, what you'd like to know about. But I'd be happy to answer any questions that you have either before or after. At the end of the presentation, I will be my webcam keeps closing, Gretchen. It says you keep closing it. So we're going on and off here. So we'll try to keep that from happening. So at the end of this webinar, you will see a email address for me. Feel free to send me any questions you might have about the topics that we're discussing today. Transition Advisors is a national consulting firm. We work only with CPA firms and only on issues related to ownership in a CPA firm. That falls into 2 general categories. We do a lot of work with mergers and acquisitions, which involves, searches, introductions, negotiations, structure of deals, all the way from soup to nuts, from the start to the finish. And we also work in the area of internal succession of CPA firms, which involves what we're going to talk about today, how to admit new partners, do a lot of work with structuring and redoing owner agreements and developing business plans around what's required to successfully provide for the succession of retiring partners. So we're going to start off, just to get an idea of who's in the audience today, with our first polling question. Gretchen?
Okay, our first question, a reminder, you need to answer all 4 to get your full CPE credits. Our first question is, how many equity partners do you have in your firm? Your choices are 1, 2 to 4, 5 to 9, 10 to 19, or over 20. Give it just a few more seconds here. All right, I'm going to go ahead and close this poll. And your answers are 55% 2 to 4, 34% 1, 8% 5 to 9, 3% 10 to 19, and nobody answered 20 and over.
Okay, thank you. All right, so we're going to discuss basically in two general areas today the issues around admitting new partners. First, we'll go through what's involved with assessing both your firm's and a candidate's readiness to be admitted. And secondly, we'll go over, the financial and agreement issues that are required to successfully pull this off. So, I work with a lot of firms on internal succession plans. It's common that when I come into a project like this, that the firm and the candidate are not at the same level of readiness. In other words, they're not synced. It's very common that either the firm isn't ready to admit a new partner, but the candidate is, or vice versa. An example is I spoke yesterday with a firm a small firm, actually a sole proprietor, and he has a person in his firm who is eminently qualified, somebody who is so strong that he's afraid if he doesn't do something, he's going to lose this person. But he's actually not ready to admit a new partner. He just couldn't, he's very hesitant about doing it. And, obviously what I'm trying to do with him is help him understand how to do it so that he becomes more comfortable. But in his case, the firm isn't really that large. It's about $1.2 million in size. And his feeling is if he admits a new partner, he's going to dilute the ownership, but he knows if he doesn't do something, he's going to lose this person. So that's an example of the firm and the candidate not being, on the same time frame. It's more frequent, though, that I actually run into situations where a firm has put off dealing with this issue for a long time. As a result, they've got quite a few partners that are looking at retirement in the near future and just don't have a very good bench. The bench isn't strong enough. So we've got a situation there where the firm is absolutely ready and in fact, desperately needy, and yet we don't have candidates who are in a stage of readiness. So when we look at how to assess readiness at the firm level, typically what we're oftentimes looking at is revenue per partner, and that's the most common measure. And I'd say it's important to consider that because if we don't, if we have too many partners for the revenue of the firm, then we're obviously going to dilute the partner profit pool, and we also could be kidding ourselves about whether or not the people that are in the firm that we're calling partners are actually functioning at that level. So, normally, and what the right amount of revenue per partner is for your firm is up to you. It can be as little as, 500,000 or 600,000. I'm going to give you in a minute some statistics around what most of the profession is seeing in the way of revenue per partner based on firm size. But it's really a cultural issue, and it's something that you have to decide on your own. Firms that have typically less revenue per partner are managing their client relationships normally with a lot of partner time, whereas firms that have a lot of revenue per partner are typically very highly leveraged, and therefore it defines the way the clients are served and the kinds of clients they have. It doesn't mean one's right and one's wrong, but it is something that you need to have an understanding about in order to know whether or not you're ready to admit new partners. The other issue, of course, is typically assessing the timing based on partner succession plans. So if you're looking at partners that are retiring in the next 5 years or less, and unless you're able to reallocate those responsibilities amongst your existing partner group, you're in a situation where you've got to admit new partners. That's not rocket science. And we'll go through in a second here how to assess the timing that's necessary around admission of new partners based on partner succession. So, throughout this presentation, I'm going to refer to benchmarks, and the two surveys that I typically refer to that I use are the Rosenberg Survey and the IPA Practice Management Survey inside Public Accounting Survey. So in the Rosenberg Survey, the categories break out this way in terms of size and revenue per partner. This, again, doesn't mean that if you don't meet these standards, there's anything wrong with your firm. It just means that this is a guide to use in how you compare with the rest of the profession. And if you're different, then just understand why you're different, but stay consistent when it comes to assessing your firm readiness. You know, I mentioned that the transition issue or the partner succession issue is oftentimes a driver in these needs. And the first thing to consider is that when a partner retires from your firm, you know, the rule of thumb nowadays is that it takes at least 2 years to properly transition that partner's duties to whoever is going to be their successor within the firm. Now, you know, if you're in a very small firm, you might have somebody who is primarily responsible for succeeding a specific partner. But in most firms, you're going to spread that responsibility across maybe several partners, some new, maybe some who are experienced. But the key is that for the clients to feel like they've been properly managed, their relationship has been respected and properly transitioned, it usually takes at least 2 years. And as a result of that, we oftentimes see now in owner agreements, this is something that's happened over the last, I'd say, 10 years, that most owner agreements now require a 2-year notice period for any partner that's going to transition out of the firm. And failure to provide that notice oftentimes results in some penalty within the owner agreement on the value that partner will receive when they leave. But just because we've allowed for 2 years for the transition doesn't mean that's enough time with respect to partner development. My personal rule of thumb when I look at this is that in order for a new partner to be in the strongest position possible, in order to take over for an experienced partner who oftentimes has relationships that are going to be 10, 20, 30 years old, that partner needs to have at least a couple years of experience as a partner in the firm prior to actually stepping into that role. So if you know, obviously 2 + 2 is 4 years. And so when you look out at the need for admitting new partners in your firm due to partner retirements, you really ought to consider the fact that you really have to have a four-year runway in order to properly execute the plan. I'm going to jump out of this for a second to another polling question, Gretchen.
Okay, our second polling question today. Does your firm have adequate talent on the bench to replace retiring partners? 1, yes, and we are confident our approach works. 2, I think so, but we don't know how to admit them. 3, no, we don't have the talent we need. And 4, we don't plan to pursue internal succession. Well, voting is quick today. I'll give it a couple more seconds. All right, I'm going to go ahead and close this poll. And our answers are 34%, I think so, but we don't know how to admit them. 32%, no, we don't have the talent we need. 20%, yes, and we are confident our approach works. And 15%, we don't plan to pursue internal succession.
Okay. One little side note here, 3 or 4 of you joined the presentation after we did the first polling question, just after we did. Technically, we can't give you full credit for not answering all 4 polling questions. I'd suggest you give Gretchen a call at our office at the end of this presentation, answer that first polling question, and we'll be able to give you full credit. Okay, so one of the things that that happens in the internal succession projects that I'm involved with is, you know, we obviously have to assess the talent pool. And oftentimes this is several people within the firm that we're considering bringing in as partners, and we're trying to figure out how to do that and when to do it. And as you go around the table, let's say we've got 7 or 8 partners sitting around the table, and we talk about each of the individuals. Oftentimes I get questions or I get comments like, well, Sally's not ready, and somebody else will say, oh, I think Sally's ready, and turns out that maybe one of the partners has worked more with Sally than another, or has had a specific experience that would indicate that she is or isn't ready. But oftentimes it's non-specific, and it isn't the kind of information that really is very helpful in terms of how to, assess whether she really is ready and how to make her ready. So a tool that I use in almost all of these projects is this tool, this characteristics of a partner. Now, this is generic. It's based on my experience over the years of working with many firms on the kinds of things that they see as the important characteristics that a partner has to have in order to be successful in their firm. If you're going to I suggest strongly that you put together a tool like this if you don't have it. It should be specific to the culture of your firm and what you value. There may be some things that aren't on here that you need to include, or maybe more specific things, because this is somewhat broad in its definition. You'll notice that 3 of the issues on here, or 3 of the bullet points, are things that you can measure. So the client management comment is obviously we're dealing with the ability to manage a book of business. Personal productivity is looking at the individual productivity of each partner in terms of chargeable hours. Growth, refers to new client development or practice development. And all 3 of those are things that you can measure numerically. The other issues on this, or other attributes on this list, are things that are more subjective. But the key is to go through this and use this as a benchmark to evaluate where your candidates are lacking, what they're strong in, and most importantly, what they're not very strong in. And then using that as the basis for the evaluation, we can decide when they're ready, and more importantly, what we have to do to make them ready. So bridging that gap would come in the form of 3 different forms of training. What I call generic competency development is what is commonly referred to as CPE. Now, if we continue to send our partner candidates to, the annual tax update that the state society offers, we're not really accomplishing much when it comes to partner development. If we're dealing with, if they need that kind of training still, and I'm not saying they shouldn't go to those classes, but if they still need that kind of training, they're woefully inadequate in terms of technical skills. So what we're talking about generally with that is the kind of formal classroom training that would address the specific kinds of subjective things that they need to be able to do in order to be successful, such as practice management, such as leadership skills, maybe some written communication and verbal communication skills. Firm culture specific development is also referred to as on-the-job training. So in this case, what we're talking about is providing candidates increasingly challenging tasks and assignments that will test their ability to, stretch themselves to a higher level of performance, and more importantly, demonstrate to you that they can handle it. Now, where I see this fall down in many firms is that, we rely on, Joe for certain kinds of things. He's really good at it, and I don't know what I'd do without Joe. So we keep giving Joe those assignments, and as a result of that, Joe doesn't grow. And now we get ourselves stuck in a position where we can't live without Joe doing those things. And so you've got to take it upon yourself as a partner in your firm to make sure that you find a replacement for Joe on those really key things you've been depending on him for over these years, so that Joe can be stretched to a higher level of performance. And then probably the most important of all of these is mentoring. It's amazing to me how many times I've asked, as we go through the partner candidate evaluation with firms, I find out they haven't even had the conversation with somebody on whether or not they even want to be a partner in the firm. And so, that's obviously where things start. But the mentoring is, sitting down with your candidates on a regular basis, having very candid, hard-hitting conversations about what it's going to take, where they lack, making sure that they're, committed to the plan. They understand what the benefits are of being a partner in your firm. Don't assume that just by watching what you do every day, they know what that means. Many firms don't share, for instance, the financial upside of being a partner in their firm, which is a very key component in creating motivation, in my opinion. Some of the partner development programs that I recommend, there's these 4, and I'll be honest with you, there's a disclaimer, all 4 of these groups are part of a group that I'm involved with that I'll discuss at the end of the presentation, called the CPA Consultants Alliance. I have no monetary interest in any of this, just that I feel like these are four of the best partner development programs available nationally, and I recommend you consider them. But this is an example of the CPE type of CPE that you can use to accelerate partner development in your firm. There are other programs available as well. The Upstream Academy, for instance, offers one that's pretty good. Again, these require a significant financial investment. More importantly, a significant time investment. A couple of these programs are more than 1 year in length, require ongoing involvement from the trainer to the trainee throughout the year, and so, but I think it's well worth the investment. One of the tactics that's being used more increasingly in our profession is the use of non-equity partners. I've just as a political comment, I'm afraid that it's to some extent being overused. I've run into more and more firms where we have as many non-equity partners as we do equity partners. There's three reasons to have a non-equity partner in your firm. One is, and the best reason is, it's a path to equity. In other words, we use it as a stepping stone, as a final training ground, as a final proving ground of a person's ability to function as a partner in your firm. And in that case, a non-equity partner probably shouldn't be in that role for longer than a couple years. What we're trying to do is give them all of the responsibilities on a day-to-day basis of being a partner in the firm without the financial commitment from both the firm and the partner to each other as a part of your owner agreement. The other two reasons to have non-equity partners is to park someone in a permanent position where we just know, and hopefully they agree, that they'll never measure up as an equity partner in their firm, but they're so valuable and key to the firm that you want to make sure you keep them. I think you can way overuse that non-equity partners for that position or that reason. And as a result, I really recommend you avoid doing it unless you absolutely have to. And then the third category is for partners that are transitioning out of the firm. So for instance, if you do an acquisition of another firm or a merger, and you have one of the partners who's leaving in say 2 or 3 years, rather than have them sign on to your owner agreement, creating non-equity position for them with a special contract with respect to how they'll be paid during the time they're working and how they'll be paid once they leave from the firm. Or transitioning equity partners that in your firm into a non-equity status while they continue to work at the firm, but while we're freezing possibly the value that they'll be paid when they leave. Going back to a benchmark, again, looking at in this case, this is the IPA National Benchmarking Report. The average for the number of years of tenure in the firm that candidates have before being admitted as an equity partner you can see on this list. Again, another political comment on my part. I think this number, these timeframes need to come down. I think the profession needs to find a way to start advancing people to equity status much quicker. If you look at where our number one pain is with respect to the future of the profession right now, it's a lack of talent. We don't have enough people that are able to do what we know we're going to have to be able to do to stay relevant to our clients in the next 20, 25 years. And so one of the things that's happening is that we're losing a lot of that talent to outside the profession, and certainly within the profession. If you're a smaller firm, I had a firm the other day who's a $5 million firm in the Southeast, excuse me, that told me that they had 4 of their people recruited from them by a Big 4 firm. Amazing. Just shows you how desperate firms can be for talent, because it used to be when I entered the profession, once you left the Big 4, you were never, back then the Big 8, you would never get back in. So again, I think that, but in looking at how long it's taking for your people to mature to partner level, this certainly is a guide as to what other firms are doing. But again, I'd recommend that you try to push that down and find a way to accelerate it. We're going to get into, during this presentation, some basic issues around owner agreements. We're about ready to enter that part of the presentation, actually. we're not going to have time to go into as much detail as you might want to know about your owner agreement, or if you don't have one, the one you should be building. A couple of webinars that I've done in the past that you can find on our website and watch are these two. Unfortunately, they're not available for CPE credit, but they do contain a lot of information about owner agreements. Excuse me for a second here. So again, getting back to a benchmark, the Rosenberg Survey tells us that they have about 400 respondents, I think, if I'm remembering correctly, to that survey, and they're of all sizes. Of the respondents, about 48% are using the multiple of compensation method for how to determine the intangible value when a partner retires, which is generally most of the value that they get paid. The book of business method is about 10%. I don't need to read through this, but as you can see, the equity system is and the AAV system are the other two major use or methods that firms are using. Believe it or not, about 12% of firms have no retirement benefit at all. They probably just pay off the capital account. And then there are other versions of things that people are doing, oftentimes a combination of the above. So the conundrum you've got when you're looking at admitting new partners and how much do we charge for them to come in, how much equity or how much ownership do we allocate to them? This is the conundrum. So you look at it from the standpoint of the existing partners, certainly the senior partners who might be thinking about retirement in the near future. You know, how do and I know I need to make this affordable for new partners, but at the same time, I don't want to give it away. I mean, I've built this value. Maybe I've got it on my personal balance sheet, and you know, it seems to me unfair that I would, you know, allocate that or just give it to somebody or make it very cheap when I've spent all these, you know, 20, 30, 40 years building up this value. On the other hand, looking at it from the standpoint of the new partner, you know, if I'm going to make a significant investment in this firm, shouldn't I have a significant return? If you're going to ask me to spend $400,000, $500,000, $600,000 to join the firm, shouldn't I be making an extra $100,000, $200,000 a year? And quite honestly, if what you're asking me to do to join this firm results in me making less money net of what you're asking me to pay in, I'm not interested. You know, I've got other things I can do with my career. So, you know, that finding a balance between those competing interests is what this is really all about, and what I'm going to try to walk you through and how to address. So we'll jump off for a second here again and do another polling question.
All right, this is polling question number 3 of 4 polling questions. Does your firm have an owner agreement? Yes, and it is signed by all owners. Yes, but not all owners have signed it. No, but we need one. Or no, and we aren't sure that we need one. All right, I think I'm going to go ahead and close this poll. And our answers are 53% yes, and it is signed by all owners. 23% no, but we need one. 19% no, and we're not sure we need one. And 5% yes, but not all owners have signed it.
For those of you that have agreements where not everybody has signed it, obviously you've got a loose end, and that is probably an indication you've got some issues that everybody's not comfortable with. Agreement needs to be redone. So, you know, this is the only time I'm going to make a pitch for us. This is something we do a lot of. I probably am involved in structuring and redoing more owner agreements than almost anybody in the country. So if you're interested in how to address that in your firm, I'd be happy to discuss that with you further. So when we look at the principles of value, and this is the section we're going to get into the nuts and bolts of, how to set up your agreement so that you can admit new partners, and then how to actually do it. When you look at the principle of value, it's important to break apart the two big pools of value in your firm. So one is the intangible assets. When we talk about a firm that's worth 1 times billings, or we talk about a firm where we're going to have 3 times compensation as our retirement benefit, that's the intangible value that we're addressing. The other part of the firm's value, which sometimes gets taken for granted and sometimes isn't even included, is the tangible value, which primarily is defined by your accrual basis balance sheet, without regard to any retirement payments payable to retired partners. So, that's generally going to be, unless you borrowed a lot of money, that's generally going to be made up mostly of your cash on hand, your receivables, and your work in process, net of, whatever payables you've got. And so those are two different pools of assets, and if we can deal with them separately when it comes to how to admit new partners, and that's actually one of the keys to this. So, for instance, as an example, and I'm going to show you later, how you can bring somebody in, not charge them much, if anything at all, for the intangible value, control their accumulation of that value over time through vesting and other programs, and make your contribution necessary to join the firm strictly based on their purchase of tangible assets. So, for instance, if we've got a $5 million firm with $1.5 million of tangible equity, a 10% interest we might make that worth $150,000, whereas we haven't charged anything for the intangible value, but we don't allocate any of that to them until down the road. I'm kind of getting ahead of myself, but I'm just giving you a little preview here. So when we look at the intangible valuations, there's no question that they are dropping almost like a rock. I would say that the concept of firms being worth 1x is almost obsolete, not only on internal valuations, but also external valuations. We do a lot of work with mergers and acquisitions, and I can tell you that most of the buyers are not expecting to pay 1x anymore. It's primarily, we can get into a whole reason why that is. That's a whole different webinar, but it's primarily a supply and demand issue right now. There's just too many firms seeking to be bought out to deal with partner succession in their firms, and there are not enough buyers to satisfy that need. And one of the ways their buyers are dealing with that is by pushing valuations down. But also because there is such a huge glut of partners that are retiring from CPA firms. I mean, we're still, like almost all American business, small business, the profession still tends to be heavily owned by older people, baby boomers like myself. And as a result, we have a lot of partners seeking to retire in the next 5 to 10 years. There's not enough talent available to make that happen and keep the firm going. So one of the ways to make this more lucrative and more affordable and more the probability higher of success is to push down the valuations. So this gives you an example of based on the Rosenberg Survey at least, what we're seeing in the way of valuation multiples as a percentage of revenues. Now, this would also apply in the case of, for instance, a method of valuing intangibles using the compensation multiple. Rather than that being a percentage of revenues, it tends to be what we're seeing is the multiples of compensation are coming down. Whereas historically they were at 3x, we're now seeing a lot of plans at 2.5. I've seen as low as 2. I've actually seen lower than 2. It's pretty rare, but and a lot at 2.75 and those kind of multiples. And so if you've got a firm that is whose partner profitability is running at 33%, and you're doing a 2.5 times multiple, that's going to result, of course, in in terms of percentage of revenue is going to be less than 1x. One of the key things to keep in mind here is the concept of sweat equity. And I think that's where a lot of owner agreements fall apart, especially those that use the equity system. I'll just explain more what the equity system is in a second here. But if you're a senior partner in your firm, you've been there for 30 or 35 years, chances are you either maybe formed the firm or one of the founding partners, or you became a partner in the firm when it was a lot smaller than it is now. And when you think back and you think, okay, this is what value, however you've determined that value, this is how much value I have in my firm, most of that value has been accumulated by you through sweat equity. In other words, you didn't pay for it. You may have bought some firms over the year. You may have paid something to get into a firm if it was already in existence when you joined. But if you've been there a long time, chances are a lot of your value is not what you wrote a check for. And so the problem is that a lot of owner agreements don't take into account the concept of sweat equity. Sweat equity results both in the partners being part of the team that's helping the firm grow, and also being part of the team that's successfully executing the buyouts and the succession of retiring partners. So I referred to the equity system, and here's an example. And a lot of you, I'm guessing, on this call use this type of system. The equity system basically establishes a hypothetical value for the overall firm. It's oftentimes based on a percentage of revenues. So if we're going to say 90% is our valuation multiple, we've got a $4 million firm. That means our intangible value is set at $3.6 million. If the accrual basis capital in the firm is about $1 million, which would be normal for a $4 million firm, then we're saying the firm's overall value is $4.6 million. If I own 25% equity, then my 25% is worth $1,150,000. And in most agreements nowadays, that would be paid over 10 years. In some agreements, the equity portion, the $1 million portion, would be paid quicker than that. But as a part of this whole concept of making buyouts more affordable, we're seeing those being stretched out as well. That partner would be paid $115,000 for 10 years. So I'm just giving you just sort of the basics of what the equity system looks like. In the multiple of comp system, the intangible value is determined based on a multiple of a partner's compensation. Oftentimes that's average compensation over, say, the highest 3 of the last 5 years. If we're using a 2.5 times multiple on a 350,000 partner, that's 875,000. Again, if we've allocated, through a variety of means, 250,000 of accrual basis capital to that partner, which would be similar to what that partner would earn in the equity system or have in the equity system. That'd be $1,125,000. Again, if we pay that over 10 years, that's $112,500 per year. The third major system, and of course the book of business system is sort of a version of the equity system, but rather than it being a set hypothetical equity, it's based on each partner's book of business. And so that can change, of course, as those books of business change. I'm not going to get into that system. It's fraught with problems because it creates a culture that many firms find difficult as they grow, because it's basically a pure eat what you kill arrangement. The AAV system is really a derivative of the equity system. So in the AAV system, we establish intangible value based, or they're expressed in terms of units, which are tied to firm volume. Oftentimes that volume is expressed in $1 of volume equals 1 unit. That doesn't mean we have to value each unit at $1. We could value it at 80 cents or 75 cents or 90 cents, which is converting that overall firm volume to a lower multiple than 1x, of course. So partners accumulate units over time, and as the firm's volume changes, that creates an incremental new units each year, hopefully through growth. that can be allocated to the current partners on some basis other than a predetermined equity allocation. So for instance, if we've got a partner, say we've got 4 partners and one of those is brand new, and we decide that we're going to allocate all growth equally, and I'm not saying you should do that, but it could be one way to do it, then any growth that occurs would be allocated, 25% of the new units would be allocated to each partner. And whereas in the equity system, typically that new growth would be allocated based on that predetermined equity, and oftentimes new partners have very little equity. The advantage of this, of course, is that it builds in a sweat equity feature so that everybody is sharing in both components of sweat equity. As the firm grows, we're allocating that growth to all the partners. As the firm is buying out partners who have retired, the value that's created through those buyouts is allocated to all the partners on some basis other than an arbitrary equity allocation. Oftentimes, new partners are not required to buy the units up front. They may start with nothing, or we may give them some small allocation in recognition of their prior efforts. Certainly, if we merge somebody in with a book of business, we'd allocate units to them based on that book of business. If a partner has grown through their own efforts before becoming a partner, say a $200,000, $250,000 book, we very well may want to give some recognition to that when they're merged, when they become a partner. But again, new partners are earning unit allocations as circumstances change in the way that the firms, both through growth and through buying out partners. What it allows us to do, though, is limit the upfront investment to the tangible value only. So here's an example of the unit system. We've got a firm whose volume is $4 million. That would be 4 million units. We're going to allocate, we're going to value those units at 80 cents each. The units that are owned by a retired partner are, say, $1 million. They've accumulated over time, which means their intangible value is 800,000. Just like in the accrual, in the comp system, their capital account might be accrual basis capital might be 250,000. In this case, my math is off. Apologize for that. It's not 1,100,000. It's 1,050,000, which would be paid over 10 years. You think I would have caught that? Sorry. So the difference between the AAV system and the equity system is that ownership in the equity system is typically not modified unless it's sold, purchased, or renegotiated. So I'm going to give you an example of how bad this can become. I worked with a firm several years ago. The current managing partner joined the firm out of school and was a superstar. When he joined the firm, there were several partners who weren't there anymore when I got there, but when I started working with them. But at that time, there were 3 partners in the firm. The firm, the 2 partners that were senior partners were managing, one was managing $1.2 million book of business, and one was managing $1.5 million book of business. And although it wasn't an eat what you kill arrangement, I mean, it was obvious that that's what they were capable of managing, and that represented their contribution to the firm. This new partner that had joined the firm out of school was managing over a $4 million book of business. Now, needless to say, they used the equity system, and at some point in time, he walked in the door and said, "Guys, I'm going to make you an offer you can't refuse. Either you change the equity allocations or I'm out of here." And as a result, when I got there, the equity allocations did not reflect what they started out at, and he had the majority of the equity allocated to him. But there wasn't a vehicle in place within the firm to do that without that sort of confrontational negotiation. I've worked with other firms where the equity system is purely used, where the only way that you can change the equity is to buy it. And so they do that a lot. There's a lot of, every year there's offers made of how much equity somebody can buy, and if they're of a mind to do that, they'll do it. And in that case, the firm actually, their compensation was allocated almost solely based on equity rather than performance. And needless to say, that created all kinds of imbalances as well. The AAV system allows you to deal with these changes in performance through how you allocate units. You know, obviously, if you've got a new partner who's contributing a substantial amount to the growth of the firm, they should probably be allocated a substantial amount of the new units that are allocated, that are created. But it gives you the flexibility to change how you allocate value in the firm as circumstances change without having to go through, you know, either negotiations or, in worst case, purchases and sales of value. So here's an example of, again, the equity system and how this can get out of whack. So we've got a firm that's $1.8 million. This was years ago with 2 senior partners, and they decided they're going to admit 2 of the junior partners. And you know, as a result, in order to make this affordable, they allocated or sold them 5% of the equity, and they each retained 45%. So of course that adds up to, if my math is done right this time, and I think it is, $810,000 for each of the senior partners and $90,000 for the 2 juniors. And quite honestly, I run into this a lot. The 2 juniors don't care. They just want a seat at the table. I don't care how much equity you give me. I don't care what, you know, what that means. I don't really think ahead that way. They want a seat at the table. Well, then 10 years later, now the firm has grown to $6 million. And let's assume that there's been an equal contribution of growth by all 4 partners. And honestly, oftentimes what I find is that the junior partners actually probably provided more of the growth than the senior partners did. But let's just assume it's equal. Well, if we go with the pure equity system, we're still at 45 and 5 because there wasn't any reason to change it. And now all of a sudden, these 2 senior partners want to leave the firm, and they think they've got, you know, they're owed $2.7 million in value, and these 2 juniors are looking at it going, wait a minute. You know, I had a lot to do with the growth of this firm, and you're asking me to basically pay for what I helped create, which, you know, needless to say, oftentimes results in a renegotiation of the deal. You know, so in the AAV system, using the same statistics, we start at 1.8 million. We don't ask the junior partners to buy any of the intangible value. We just limit that to the tangible capital contribution. Each of the seniors has 900,000 units, but over time, because the growth is allocated equally, and again, I'm not suggesting that's how you do it. It's just makes this easy to explain. Now we've got a situation where the 2 senior partners have accumulated a fair share of the growth that's been created, and the juniors have also accumulated the same. So we don't have that same imbalance. How much should you charge a partner to come into the firm? Now, I will tell you that if you use the Rosenberg Survey, you're going to find much different numbers in the Rosenberg Survey. And I did some further investigation of the details behind that survey and found that firms that use the equity system tend to charge a lot more for a partner to enter the firm than firms that use other systems. And makes sense because they don't want to give away the value that's already been created. But this gives the IPA survey, I think, limits the capital contribution to what actually goes into the capital account. So in that case, you can see here's some examples of what firms are charging new partners in the way of capital contributions to join the firm. Another issue is, of course, new partner compensation, again, using the IPA survey. I think what's important here is to consider that oftentimes, you know, there's a progression from non-equity partner status to equity partner. And basically, that promotion on average is running about 23.5% of a raise from non-equity partner to equity status. If you don't use non-equity partner status, I think that's also a fair amount of increase in compensation to target for your newly admitted partners, even if they're being admitted from manager status. Excuse me. So an important part of of your owner agreement should be the vesting program. Why do we have vesting in the first place? I know you can't answer. I'll answer for you. Let me catch up here with my notes. You know, basically vesting allows you to, or allows a new partner, young partners, to accumulate value in the firm, which is what they're going to need in the long run, without actually creating a scenario where they can run off with that value by an early exit from the firm. You know, one of the key things, especially in the firms that are of the size that are in this presentation, is that, you know, partner succession can be dramatically impacted by the early loss of one or two people. So if we're counting on, and we've got a 5-partner firm, and we bring in 2 partners to create a stronger team for succession for the partners, if we lose 1 or 2 people early, that can completely upend our plans. We can't make people work for us. I mean, if someone wants to leave, they can leave. What we want to make sure we're not doing is creating a financial incentive for them to leave early. So accumulating, oftentimes for a young person in their 40s, accumulating, you know, $500,000, $600,000, $700,000 of value could be enough to say, you know what, that's a pretty good nest egg. I can make that work for a while. I'm gonna head off somewhere else. And so vesting keeps that from happening without withholding the allocation of value in the long run. So what we're trying to do is promote longevity of the succession team, and we're also trying to allow for the allocation and accumulation of sweat equity during the early years. So vesting tends to run in 2 categories: tenure vesting and age vesting. A lot of agreements have both. You know, tenure vesting is how long you've been a partner in the firm, not usually how long you've been at the firm, but how long you've been a partner or equity owner in the firm. And those vestings tend to run between 10 and 25 years. I usually recommend 15 to 20 years in the agreements that I'm working with. And usually we'll set up 50% vesting at about halfway, at the halfway point. So if it's a, you know, if it's a 20-year vesting program, then after 10 years, they're 50% vested, and then they might accumulate an additional 5% each of the next 10 years. Age vesting, of course, ties the vesting to the age of the person. This is a little more problematic because there's so many firms that are admitting people now at advanced ages to partner status. So we usually have to deal with grandfathering or special overrides and so forth. But again, age vesting tends to run between 55 and 65 years of age. I don't like using 65 because that's oftentimes also the mandatory retirement age. And I hate for someone to be forced to stay to mandatory retirement in order to become fully vested. But so oftentimes we'll set the age vesting at full vesting at age 62 in those cases. But, you know, I don't think that's that important. And the other thing that's happening, of course, is that many firms are stretching mandatory retirement ages now to as late as 67 or even 70. So, you know, strong vesting provisions allow you to be comfortable that you're going to allocate value to newly admitted partners that they haven't actually paid for without feeling like you're giving it away, because they're not going to have access to it for probably till after, you know, the senior partners leave anyway. It's an absolute must in the case of a system that uses the compensation multiple system, because without vesting, of course, a person that's even earning as little as $150,000 would have $300,000 to $400,000 or $500,000 of value on day one that they could walk away with. The AAV system actually, because of the nature of how you develop and accumulate units, really has vesting sort of built in. But I still recommend that you use a strong vesting program with the AAV system, because hopefully your junior partners will be accumulating a lot of units fairly early in their career. This will take us to the last polling question.
All right, this is polling question number 4, and don't forget to get your CPE credits. At the end of this webinar, there will also be a survey that pops up that you will need to fill out. Polling question number 4. I believe our approach to valuing our owner's interest in the firm is 1, fair and affordable; 2, fair but I'm not sure we can afford the buyouts; 3, not fair, too rich, 4, not fair, too low, and 5, not applicable, we don't have an agreement. All right, we'll give a few more seconds here. All right, I'm going to go ahead and close this poll. And our answers are 51%, we don't have an agreement, 30% fair and affordable, 16% fair, but I'm not sure we can afford the buyout, and 2% not fair, too rich. There's 0 on not fair, too low.
Okay. My guess is those that think it's too rich are not the older partners in that firm. But anyway, whatever your problem is with your agreement, I'd be happy to talk to you about how to fix it. So I'm going to breeze through here real quickly some examples. So we've got a $7 million firm with $1,750,000 of capital, 90% valuation multiple in the equity system or AAV system, and $150,000 current compensation for a person we want to admit as a new partner. In the equity system, if we're going to charge them 10% equity at buy-in, in order to make this, quite frankly, work, you'd have to charge them $630,000 in intangible value, because that's 10% of 90% of 7 million. We'd have to charge them another $175,000 for their capital contribution, so the total buy-in's $805,000. We may issue a loan to them. We may ask them to go to the bank. Either way, you know, a reasonable 5-year amortization is $160,000 a year. You know, their compensation is going to have to go up at least by that much for it to make any sense to them. And that probably doesn't make any sense to you. Why would somebody who was making $150,000 all of a sudden be making over $300,000, probably more like $350,000? And, you know, and was that really a good financial decision on your part if you sold for $630,000 something that's you're going to carve off $160,000 a year or more in compensation? So as a result, to make that make more sense, we tend to, you know, drop the 3% down to 3% equity. Now we're talking about a number that is more affordable at $48,000 a year, but now we've only got 3% equity. We basically have kicked the can down the road. Eventually, we're going to have to deal with the fact that it's only 3% equity. So how do we adjust that person's equity, you know, 10, 15 years from now when that 3% doesn't make any sense anymore? So the alternative that I see oftentimes used is, okay, we'll just go ahead and give them a certain percent of the intangible value, and we won't charge them anything. We'll just, you know, have them pay in maybe a token $25,000, $30,000, $40,000, and then we'll just give them the equity. But then what? I mean, we're back basically to the same scenario of, because we probably gave them a token amount of equity, 1%, 2% is very common. You know, what have we really accomplished in the long run? You know, typically in the comp multiple system, we don't charge for intangible buy-ins. So the capital contribution, going back to our example, might be limited to that $175,000 for 10% equity, or, you know, oftentimes we're setting it at a standard that all partners have to meet. So we might say, you know, that's everybody contributes 100,000. That's what you need to contribute. Or sometimes we do it based on relative compensation. You know, the sweat equity tracks with the compensation, so, you know, we control it through vesting. In the AAV system, we basically can do it the same way as a multiple of comp systems. Since we're not allocating intangible value, we don't have to charge them for it. So all we need to do is charge for the tangible buy-in. My recommendation is that you consider using either the comp multiple system or the AAV system. If you're currently in an equity system where you have equity that's owned disproportionately by a couple of people, the AAV system is a great way to transition to a different system without everybody giving up what they already have in the way of value. Some additional information you can get from articles that we've written for the Journal of Accountancy and Accounting Today. You can get those on our website. Here's a list of those articles. I also recommend you consider looking at the PCPS Succession Planning Resource Center. This is a link to it. We've contributed quite a bit of the content that's on that website. I'm a member, as I mentioned, with the CPA Consultants Alliance. These are the other members of that alliance. We have some pretty good information on our website that you can access. We've written 3 different white papers, and we're very close to issuing the next one, How to Beat the Robots, dealing with the accounting industry's shift to consulting. And we've also written a book that you can get on Amazon and on CPA Trendlines. Obviously, you'll save money at CPA Trendlines. And as promised, this is how I can be reached and how you can reach more information on our website. Thank you for your attention today, and I'll turn it back to Gretchen.
All right, we'd like to thank you all for attending today's webinar as we are at our hour mark. Those who have posted questions, Terry will get to those individually after the webinar. Please note that to receive your CPE credits, you will need to complete the survey that appears after I close the session. And we hope you all have a great rest of your day, and we look forward to you joining us at future webinars. Thank you.